That does not happen. And there's certainly more no's than there's yeses in that regard.
Let's say they look at that, and as they have here, they clearly thought it was different. It was differentiated. The return stream doesn't behave at least exactly like the strategies, their existing strategies. How does the process evolve from that moment? So you had the first meeting. They've done the deep, rigorous quantitative analysis on your return stream and how it compares to the other stuff they have. I imagine you tell some sort of a story as well. I guess, how does that evolve?
Yeah. So then the next step was then taking I guess in the weeds of the due diligence process, but it's really taking a deep dive into how do you generate the returns. So it was really walking through forecast models, how they're constructed, what are the data inputs. I alluded to some of the data inputs, but going deeper into what are the data inputs, how do you use technology to assess this data, how do you then build forecast models from kind of the features that you extract from data. There's where the conversation goes. That can happen over the course of, it could be weeks, could be months, but those are several conversations around really having a deep grasp for what we're doing and how we're achieving returns.
How do they do the deep due diligence without, I guess, uncovering all the secrets? Can you elaborate?
Yeah, so obviously we have intellectual property that we're seeking to protect. If we're doing a good job of describing the process through storytelling, through case studies, I think folks can get a good appreciation for how we generate returns. So one of the things that we oftentimes do is, we'll describe the forecast models and we describe the inputs and how we go about building them. But what people care about is the output, right? So we'll describe the output through different case studies. So a case study you might describe, there was about a year ago, there was a deal we looked at, 2 industrial companies in the UK where there was a competing bid situation and we accurately predicted this competing bid. Now, how do we go about accurately predicting this competing bid? So now we describe the scores of every forecast model. So for one of our forecast models, we're seeking to predict, is this deal going to happen or not? The probability of success or failure, that score particularly high. The next forecast that we care about, and this is a meaningful forecast for us, is the probability that a deal at announcement date, what's the probability that it's actually going to close at the price announced or something higher? That's a very important one for us. Why that competing bid or that upside that we capture enables us to generate substantial alpha. It also enables us to completely mitigate, and it's actually 2x the returns of deals that we're going to ultimately have that are going to fail. So we pay careful attention to these competing bids. We pay attention to how long deals are going to take to close. We pay attention to the liquidity of a stock. We pay attention to spreads and we forecast volatility. From all these inputs, and we will describe that story about how we generate these probabilities and these forecasts, we come up with an expected return and a risk, right? That story around how do we go about assessing a transaction, how we go about thinking about upside, how we go about thinking about downside, how do we ultimately size, and then the output, I think is helpful. And understanding that through a course of a series of transactions and then how we go about blending the portfolio is meaningful, and I think helps people understand the process a little bit more intimately.
They do their due diligence. The story's consistent. They like the process. They like the team. What do the mechanics of the allocation look like?
The mechanics of it in terms of how they actually put money to work.
Let's say, awesome. And I know we've gone through the process and we've oversimplified a lot of stuff, and I'm sure there's a lot of meetings, and it's not as simple as here are returns, one meeting, due diligence, bang. Right? I doubt it. It's like obviously, there's a lot more, but just let's say all those steps have happened, and then they've done their due diligence. They like the product, they want to allocate, and in this case, they say, hey, we'd love to chuck in $500 million. What does that look like? Do they give you a little bit to start? Does it, just curious about that.
Yeah, I'm gonna address something you said. So the process, and we as a firm, and I think perhaps your listeners might want to hear this, and I think a lot of folks would agree, in an investment management business, there are two things that are very hard to do, and I think one is harder than the other. So one is really hard to generate returns. It's a competitive space. There are a lot of smart people in the world. There are a lot of, and particularly now, there's a lot of smart machines that are working with smart people, and it's really hard. It's a competitive space. What's even harder is raising capital, and it's almost an impossible task to actually raise money. And doing that, it requires a tremendous amount of work. And you're right, it's not just sending a return stream, sending a deck, having a conversation, right, and somebody's gonna write you a check. That doesn't happen.
$500 million. There you go.
That does not happen. And there's certainly more no's than there's yeses in that regard. In terms of when you win the allocation, it depends on the structure, the multi-manager, the multi-strater, the managed account platform that you may be engaging with. So there are two types of allocations that can happen in this space. They're some refer to them as internal and external. I'll start with external first because it's a little bit more intuitive and it applies across a number of different manager types. External allocations are managed accounts. So, you have a segregated account that you manage for a client, but you're in charge of that account. That account is owned by the client. They may appoint the counterparties, so the auditors and the prime brokers and other counterparties that are involved in a managed account. But you trade that account as if it were a fund that existed outside of your commingled fund. So you can think of it like as a separately managed account, a separately managed fund, and it's a bespoke vehicle. You have internal managed accounts or in relationships with managers where you effectively trade a portion of an entity's balance sheet. So they segregate a portion of their internal balance sheet, and there's X amount of dollars. You instruct the trades on how that portion of the balance sheet runs, but the execution takes place at the multi-manager himself. So they would be in charge of executing those trade orders and reconciling the trades, but you're instructing that portion of the balance sheet on how you would like it to trade. Typically, that allocation, so if it's a $500 million allocation, it depends on the structure. Typically, folks are not allocating that all at once. It's hard to put that amount of capital at work, instantaneously. They're probably legging into that trade over the period of months. And the allocation structure is something that might be prearranged with between the manager and the allocator. But you say that you want to leg into that over the course of 6 to 12 months. It's typically kind of the cadence around how that might be put to work.
You touched on external versus internal allocations. And with internal managers, the way, at least the picture that's painted online is they have the risk limits and they decide the fund decides to size up and size down on different managers. And, in some sense, treat them as positions. If someone is doing great, uncorrelated, has a great return stream, someone else is not performing like that, it just makes sense to size one guy up and one guy down, or one girl up, one girl down. How does it work for external allocations? Is it the same in that regard? Can they size up and size down basically discretionarily? I guess, how does that work? Is it a drawdown limit? Would love to hear it.
Yeah. I would say there's no one size fits all. And I hate to answer a question with it depends, because that's a non-answer, but it depends, right? So I think there are certainly platforms that are more mechanical in how they think about drawdown limits and how they think about sizing positions up or down. That certainly exists. There are other platforms where the constraints are not as rigid, and I would say the allocations to a given manager are not necessarily formulaic, but might be a bit more discretionary. I don't know if there is a mechanism that's better or worse, but it certainly depends. I think from the perspective of the multi-strategy fund or the multi-manager platform or managed account platform, I suspect many of them don't at their core don't have a divergent view as how they might treat an external manager or an internal manager, right? I think the end goal when they think about the product that they're offering their client is to maximize return and risk. And how they go about achieving that goal is selecting talented men and women to manage portions of their fund and portions of their balance sheet, whether or not those managers reside in-house, and in-house is figurative, it's not literal in many cases, whether or not they reside in-house or externally. I'm not necessarily sure that the average platform fundamentally views those exposures differently, because the goal at the end of the day is to servicing their end client.
What does the typical fee structure look like for an external allocation? Is it the 2 and 20? And I know 2 and 20 is hard to get these days, but yeah, what's it generally like?
Yeah. So it's certainly there is I think the fee arrangements are similar to other allocations. So there's a cost to running these strategies. There's just a baseline cost in terms of data, infrastructure, people, technology. That's oftentimes captured in the management fee. So that's a portion of fee. Some portion of fee is dedicated towards just the managing, the day-to-day operations and managing of the strategy. And there's a portion of the compensation that comes from generating positive returns. So the mix between kind of flat fee of some sort, call it a management fee, and some reward for generating positive returns is similar to that of any other client account relationship. The amounts and I think that's a little bit more nuanced. So what that ratio looks like, I think is reflective of, quite frankly, kind of the amounts that you might charge on your commingled vehicle.
And I guess now, which is a great time, and I want to talk about the difference between allocations in a typical fund of fund structure, typical allocator, call it an endowment or a pension fund, versus multi-managers. I guess what are the differences in the way they think?
Yeah. So now if you talk about comparing a traditional fund of fund versus a multi-strategy fund, I think they're very different in their approach. Traditional fund of fund is allocating to several managers across various various strategies across various asset classes. They may or may not be allocating to a commingled fund. Oftentimes they're not having day-to-day control and transparency into what the managers are doing. So it is an arm's length allocation to the fund that the manager is trading, and it behaves like any other arm's length engagement. In the case of a multi-strat, the relationship is a little bit more intimate in regards to there is likely daily transparency on what's happening. Understand when I say what's happening, the trades that managers are taking, the exposures that managers are taking, how they're increasing or decreasing leverage on a day-by-day basis, on a minute-by-minute basis. So there's complete transparency in terms of the execution of the strategy. That's diametrically opposed, very different. The other aspect is with regards to the point you were making, how the fluidity around increase or decrease in exposures. So a traditional fund of fund, increase or decrease in exposure to a manager is really contingent upon the liquidity constraints of that manager's allocation. So if it's quarterly liquidity with 60 days notice, that's a period in which you can increase or decrease exposure to any given manager. There are some constraints around capacity. Maybe it takes a little longer. If there's a lockup or a gate, maybe it takes even longer still. That fluidity or lack of fluidity does not exist in the typical multi-manager account, where you would have pre-negotiated capacity of some sort. And within those capacity limits, you have a lot more access to increase or decrease exposure based on kind of your risk, your asset allocation, and portfolio construction requirements. Now, there is this hybrid world where there are fund of funds that have managed account platforms or launch things that optically resemble what's happening with multi-managers that are have these external allocations. So fund of funds, and I'm using this term very broadly. Hopefully I'm not offending anybody that might not describe themselves as a fund of funds, but fund of funds who are, have managed account platforms that increasingly have, more transparency, have control of the assets. Now, these structures can closely resemble to what we're seeing in the multi-manager space. I think there's some nuances and difference there, but there is this, and they started this conversation about talking about kind of the morphing of kind of these two worlds. We're certainly seeing that today.